So hi there, my name is Mr. John Mark. I'll be taking you through advanced financial reporting, and today I want us to cover a topic called employee benefits. That's under IAS 19. And employee benefits are all forms of consideration given by an entity to an employee for the services rendered to that organization by the employee. So such as we can see salaries, commission, allowances, per diem, etc. Those are what we call employee benefits. And IAS 19, employee benefits are classified into various classes. So now let's look at type of employee benefits. And one, we have what we call, number one, short-term employee benefits. Number two, we have what we call termination benefits. And number three, we have what we call retirement or post-employment benefits. So those are the major three types of employee benefits. I start with number one. Number one is what we call the short-term employee benefits. Short-term employee benefits. And short-term employee benefits, they are benefits payable to an employee within a duration of 1 year or within 12 months, such as, e.g., salaries, wages, commission, bonuses, etc. Those are what we call the short-term employee benefits. Then we have termination benefits. Now, termination benefits, they are benefits payable to an employee upon work being terminated by either the employee or the employer. So that's what we call termination benefits. They are benefits payable upon work being terminated by either the employee or the employer. And then we have number three, what we call post-employment benefits or retirement benefits or the pension. And the post-employment benefits, they are benefits payable to employee upon retirement. And that's why they are called retirement benefits or the pensions. So, and that's what I want us to focus on. I want us to focus more on on post-employment benefits under this topic. And we have said that they are benefits payable upon retirement. And we have two types of retirement benefits, or we have two types of pension plan. So we look at types of pension plans. One, we have what we call defined contribution plan. And number two, we have defined benefit plan. So those are the two types of pension plans we have. And number one, we have the defined contribution plan. Now, under the defined contribution plan, the benefit payable upon retirement will be based on the amount of contribution made by both the employee and the employer to that scheme. So we are saying that under defined contribution plan, the amount payable upon retirement will be based on the amount paid by both employee and employer during their career life. So and in this case, we also say that in this case, the employee bears the uncertainty of the amount receivable, will bear the uncertainty. Now, for example, assuming you as an employee, the amount contributed to that pension during your career life was 3 million. That's what was contributed by both the employee and the employer. So in your account, we contributed 3 million. Now, upon retirement, the amount receivable is said that it will be based on the amount you contributed. But we are saying that the employee will bear the uncertainty of the amount receivable. That means upon retirement, if you contributed 3 million, will you get 3 million? Will you get 3 million? So you will not get 3 million. You will get 3 million plus. Why? Because what they usually do as the pension plans, the amount you contribute there, they usually do reinvest this amount. And when they invest the amount they get, or as a profit of the returns, they need to share with you, because remember, they invested using your money. So in this case, you have 3 million plus some returns or profits. And these profits will be based on how the investment was performing. If the investment was performing better, the higher amount you will get. So in that case, we are saying that the employee bears the uncertainty of the amount receivable, which will be based on the performance of the investment. Then we have defined benefit plan. Now, under defined benefit plan, the amount payable upon retirement will be based upon on either the final salary or the average salary during the career life. So the amount payable will be based either upon on the final salary or the average salary, but this computation will be based on what we call the actuarial assumptions. Actual assumption, we mean that, for example, they might decide that they take 2/3 of your average annual salary, and then they multiply by the number of years of service. So take the average salary times the year of service. Now, this 2/3, this is what we're saying, that this calculation will be based on what we call actuarial assumptions. And for actuarial assumption, we have what we call the financial assumptions. Those are the factors to consider. And for financial assumptions, they may look at things to do with inflation rate, required rate of return, interest rate, etc. And then another actuarial assumption they need to consider is what we call demographic assumptions. And for the demographic assumption, the assumption which include to the rate at which maybe they look at the mortality rate, the claim rate under the medical plan, things to do with that. Also the labor turnover, etc. So they will be based mostly on the financial assumption and the demographic assumption. And those are the two types of pension plan: defined contribution and defined benefit. Where defined contribution, the amount of the pension received upon retirement will be based upon on the amount contributed during the career life. But defined benefit plan, the amount payable upon retirement will be based upon either on the final salary or the average salary, but the computation will be based on the actuarial assumptions. Good. So now let's look at measuring defined asset and liability. How do we measure asset and liability? So measuring defined plan asset and liabilities. So in this case, the amount of starting at the beginning of the year and the amount at the end of the year, they will be reconciled to determine whether there was an actuarial gain or whether there was an actuarial loss. That's what we call reconciliation. So you're saying that the amount at the beginning and the amount at the end will be reconciled to determine the changes. So let's start with how do we measuring defined plan asset. So we start with defined plan asset. How do we measure this? And this is how we measure the defined plan asset. The format is very important. You take the fair value of plan asset, balance brought down, then you add contribution to the plan, and then you also add return on asset, return on plan asset, you add it, and then you deduct the amount of benefits paid, So what you get there, you can call it the carrying amount. Now you compare the carrying amount against, it will be given the fair value of plan asset, balance carried down, the market at the value at the end of the year, it will be given that. So now the difference between the carrying amount and the fair value balance carried down, that change is what we call actuarial changes. Now actuarial changes, it can either be an actuarial gain or actuarial loss. So it can either be an actuarial gain or actuarial loss. And how to determine the gain or loss? If the asset increases or when the asset increases, that's what we call an actuarial gain. But when the asset decreases, we say it's an actuarial loss. Then number two, that's number one. Number two, defined plan liability. So how do we measure defined plan liability? And this is how we measure. You take present value of obligation or liability, balance brought down. Then you add, remember liability gives rise to expenses. You add expenses, one being the current service cost. Then we have past service cost and also the interest cost. You add those three classes of expenses: current service cost, past service cost, and the interest cost. And then you deduct the amount of benefits paid. There's the amount of benefit paid. Then you get your carrying amount. And then you compare your carrying amount against the present value of obligation, balance carried down. You'll be provided with that. And now, the difference between the carrying amount and the present value balance at the end, it's also what we call actuarial changes. Actuarial changes. It can also be actuarial gain or actuarial loss. They are also known as measurement gain or measurement losses. So that's basically the format on how to measure defined plan asset and defined plan liability. So now with that, I want us to look at an illustration from the past paper. You can take out your past paper. We do an illustration. And let's start with September 2015. September 2015, question 4A. September 2015, question 4A. So let me read the question. And we are told that. So first of all, when you're measuring the defined plan liability or assets, the format does not change. So you can first of all even write the format, and then you'll be inserting the values because it does not change. And we are told that Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan asset was 2.6 and the present value of plan liability was 2.9. So let's fill that. We are told that on 1st January, the fair value of the pension plan asset was 2.6. So the fair value of plan asset balance brought down, you are given was 2.6. And the present value of plan liability was 2.9. The present value of obligation balance brought down was 2.9. Then you are told that the second paragraph, the actuary estimated that the current and the past service cost for the year ended that 1st December 2014 at 450 and 90 respectively. Estimate the current service cost at 450 and the past service cost at 90. Remember I said that to the defined liability, you take the present value of obligation, you add the current service cost and the past service cost. Then I told that the past service cost is caused by the improvement in pension benefit commencing on that 1st December 2014. The pension plan paid 240 on that 1st December 2014. The pension plan paid 240. Now that 240 is what we call benefits paid. And we say that for the benefits paid, you deduct from both, that was 240, from both assets and whereas to the liability. You see, we said you deduct less benefit paid, and benefit paid was 240. You deduct that. So the pension plan paid 240 on that 1st December 2014, and on the same date, Volta Limited paid 730 in contribution to the plan. Volta paid 730 to contribution to the plan. So we say that under the assets, you add contribution to the plan, and there was an amount of 730. Then, interest rate on high quality corporate bond for the year was 8%. The interest rate was 8%. So how do we use the interest rate? So now, return on plan asset, you'll take 8%. If you invest, you'll get an interest of 8%. So you take 8% of the balance brought down. So how much was the balance brought down? For the asset, the balance brought down was 2.6. Then, so how much is that? You get it's an amount of 208. The same for the liability. For the liability, we have the interest cost. For interest cost, you take 8% of the obligation balance brought down, which was 2,900. And what do we have there? So in that case, we'll have an amount of 232. We continue. Then you are told that as at the year end, fair value of pension plan asset was 3.4 as at the year end. So that's the fair value of plan asset. So the value was 3.4. And present value of plan liability was 3.5. The present value of liability was 4.5. Was 3.5. Like that. Now, in accordance with year 2011, revision of IAS 19 employee benefits, Volta Limited recognizes measurement gain and losses in the comprehensive income, in other comprehensive income for the period they occur. And remember, those measurement gains and losses is what we call actuarial gains and losses. Required. Calculate the measurement gain or losses on pension plan asset and liability that will be included in the comprehensive income for the year ended that 1st December 2014. So let's compute that measurement gain and losses. So we start with the assets. For the assets, you take the fair value, you add contribution to the plan, you add return on plan asset, you deduct benefits paid for you to get the carrying amount. So how much will you get? So it's 2,600 plus 730 plus 208 minus 240. Find the value of that 298. Then, the difference between, now you compare the carrying amount and the balance carried down. The carrying amount was that 298, but the balance at the end is 34. So what has happened? So there was an increment from that 298 to that 400. There was an increment by an amount of 102. So what is that 102? Now that's what we call an actuarial gain. That's what we call actuarial gain because it was an increase. Let's go to the liability. To the liability, you take the present value of obligation, that's 2,900. You add current service cost, you add service cost, past service cost, and the interest cost. Then you deduct the benefits paid. So to get our carrying amount. So how much will be our carrying amount? Our carrying amount will be 34,32. Now that's our carrying amount. Now you compare your carrying amount against the balance at the end. So from 34,32 to 3,500, there was an increment. And there was an increase by an amount of 68. An increase by 68. So what is that? That's what we call actuarial. Have you answered yourself? That's what we call actuarial. There was an increase. So that's what we call an actuarial loss. Remember, when a liability increases, it's not like an asset. When an asset increases, it's a gain. But when a liability increases, it's a loss. So that means how much will be our net actuarial? Our net actuarial changes. You see, from the asset, we had an actuarial gain of 102. Then we have an actuarial loss of 68. Now, the difference between the two, which is 30, that's 30, yeah? Yeah, which is 30, yeah? The difference between the two, this is what now you'll take it to other comprehensive income. The difference between the two, sorry, this should be 34, not 30. Yeah? The difference between the two, you take it to the other comprehensive incomes. And I'll show you where we present other comprehensive income. So you may look at that. Then we try another question still from the past paper.